Hi, I'm Mark from Property Ventures. Welcome to this week's New Zealand Property Podcast, where we interview the property expert around New Zealand. Hi, I'm Mark Honeybone from Property Ventures, and today we continue this two-part series with John Bolton from Squirrel Mortgages. We will continue to discuss working with a mortgage broker and give you some insights on how John invests and his views in the property market today and some of the opportunities he sees this year. We hope you enjoy the show.
So, multi-income properties where it's more than three incomes, tiny bolt hole apartments and leasehold property typically are difficult to sell when the market is in bad shape. And so the banks, hard to sell properties, the banks sort of label as non-standard. Basically, they discount the value of the security, and they'll only generally lend up to about 65% on them.
Okay, so 65%. Okay, so apartments, for less than 50 square metres, leasehold just said, and it's more than three incomes. Oh,
Yeah.
I get cross signals. So sometimes people saying it's three and less, but it's more than three, or does it still depend on the bank?
It depends on the bank. Look, all the banks are different in that regard, and then it not only just depends on the bank, it also depends on the situation of the borrower.
Yep.
So, all the banks' credit policies are different. But, one of the things that I would signal, and it seems to have found its way into the paper a little bit in the last month or so, I think one of the articles was actually quoting me, but the Reserve Bank is putting through a policy change around property investment that says, investors that are generating more than five incomes.
Yeah.
Now, that's not five properties, that's five tenancies.
Right.
So people that have more than five tenancies are going to be treated as business for the purposes of capital allocation. Now, the implications of that are that investors are going to find themselves in business banking probably far quicker than they have in the past.
Yeah, absolutely.
The pricing isn't as good through business banking as it is through retail. So investors who are dealing with mobile mortgage managers have probably historically got better rates than they'll get once they're in business banking. The other issue is that it has implications for how much capital the bank's got to hold.
Okay,
so whilst I don't expect it to have any short-term impact, I think, over the next 3 to 5 years, you're going to start to see banks treat investment property mortgages differently to retail mortgages. And I wouldn't be surprised if it doesn't become its own mortgage product. And that you start to see some level of price differentiation, i.e., you actually pay more if you're if you're an investor than you will if you're just sort of a retail customer.
Right. A few sort of questions, I suppose, come from that. So how, is that something that's still looking at doing at the moment? It's not in concrete, and are you saying it could take up to about 5 years for that to happen, or?
No, it's decided, and it's getting implemented in June.
Okay.
So it's actually around the corner. But I don't think it's a major, and I don't want to sort of overstate, the change. But it does have implications. Those implications will probably take a while to filter through.
Right.
And look, it's because it's not a massive change. It's actually quite a subtle shift. So I don't think that the banks will knee-jerk respond to it.
They're not instantly going to go, you can only have a 65 or 60% lending situation and over your whole portfolio, or those sorts of things happening?
Yeah, well, look, I mean, that sort of happens for larger investors now. So
yeah, it does. Yeah.
For some of my larger clients, generally the bank's sort of trying to drag them down to an overall LVR of 70 to 75.
Yes, yeah.
So I don't think it's changing too much from what the banks do today, certainly for larger investors. But it's probably just lowering the boom a bit. So there's probably a group of investors out there that got away with staying in retail longer than they should, and now they're going to find that things are going to be a little bit tighter for them.
Yep. No, that makes sense. Just with different types of the lending out there. I remember we've spoken previously or a little bit about back in 2006 and 7, the previous cycle, and there were a lot of second and third tier lenders, and you've just touched on them at the moment. I mean, they're out there in abundance and doing some crazy lending. In fact, I remember one of them was lending something like 115% of the value of the property.
Yeah.
Who's out there now, and what sort of degree are they compared with back in those days?
Yeah, okay. So there's probably a couple of things. So back in 2005, 2006, maybe through to 2007, Lowdoc Lending got really prevalent in New Zealand.
Yep.
It was a huge growth product. There was a lot of it happening. A lot of it would have been property investors. It was aptly called Liar's Doc, because essentially all you had to do was sign a piece of paper, write down what you thought your income was, and the bank would treat that as gospel and give you heaps of money. Whether you call it fraud or not, there was certainly a lot of lying going on.
Yeah.
And the money was flowing out pretty easily. Not surprisingly, with the GFC, that was where most of the banks lost money.
Yeah.
So, I was in the bank at the time, and most of our losses were against that Lowdoc product. And a lot of those losses were also coming from offshore investors. Which is wI that's one part of the market where you still see the banks are reasonably conservative. So I guess, Lowdoc product pretty much disappeared. It was a knee-jerk reaction to the fact that banks lost a lot of money there. It's certainly a lot more difficult now to buy property in New Zealand if you don't have New Zealand citizenship. So, you're a true foreign investor that has no tie to New Zealand. And that really stems back to that time. As far as the second tier lenders go, most of them went under. There's only really two left. So we've got Resimac and Liberty, who effectively are a bit like the banks. They'll lend up to 90%. On residential security, pricing wise, that they're pretty competitive against the banks, and they're still in the market, and those guys are reasonably good, but that's basically it. And then below that, you're down to asset lenders. There's probably two or three big ones. That's all small, but doing business. DBR, ASAP, and Cressida, and there's a few smaller ones. Those guys will basically lend up to generally up to 65-70% of a property's value, but they don't require any income verification or anything like that. Interest rate wise, though, they're expensive. They're up around 9% interest, and you've got upfront fees of somewhere between 2 and 3%.
Right. Are they? I've just talked to a broker a few weeks ago, and they were mentioning he was calling them a private lender. Is that sort of like an asset lender, or?
Yeah, look, that's probably another tier again. So asset lenders are actually commercial businesses,
okay.
And they're out there lending every day. Some of the older, more seasoned brokers do have access to private investors. I do a bit of that stuff where I can link people together. So I can link investors with borrowers and do some private loans. So we've done a bit of that sort of stuff. The situations often with things like relocatable homes, which are very hard to finance.
Right. Yeah.
So I did a deal recently. It's a classic example of it, actually. So the guy basically got a big piece of land under contract, paid a 10K deposit. Now, this is a guy that had previously been bankrupted, so he had, not the greatest credit record. He bought the land. He got it under builder's terms with a 10K deposit and about a 9-month settlement time frame. The land was getting subdivided, so title hadn't come through, so it was easy for him to get builder's terms. He basically went to a developer that needed a house removed from a development that they were doing, and he offered to take it off them for free.
Nice. What a
And so
bloke.
then yeah. So then he approached us and he said, "Well, look, I've got a house for free. It's over here. I've got this piece of land under unconditional contract over here, and I've got a valuation based on that house being on that property, and but I don't have the money to get it there."
Nice.
So we basically got him about 120,000 with no security because I mean you can't secure a house that's not on land, and the land wasn't settled; it was under builders' terms.
Okay.
So we used one of our private funders, and they just took an assignment over the purchase contract for the land, and we just drafted up some sort of security agreement over the random house,
Okay.
and they funded it. So they basically funded the consent costs. They funded the cost of moving the house, which had to be chopped in half and then reassembled. They funded all of that, got the house on site. And then that got him to a position where he could then refinance all of that back into a mainstream lender.
Great work. Yeah, that's awesome. And that's obviously the banks, wouldn't look at anything like that. But if, by going through a broker and getting an investor like that, that's great.
Well,
Great
I
outcome.
mean, but great for the client. I mean, it's probably one of the best examples I've seen someone do something with absolutely nothing. I mean, it was a pretty stressful process for him, to be fair. I think he found it pretty tough, and I think he didn't enjoy it as much as he thought he would. But here's a guy that didn't have a lot of money and he went and created at least a couple 100,000 of equity through this process, and he only used about 20 or 30,000 of his own money.
Yeah, that's tremendous. That's a great wee story there. It's inspiration for some of the younger listeners listening right now.
But it doesn't mean I want lots of these crazy things coming through to me. They're not easy.
No worries. I think we sort of covered the next question a little bit. I was going to say the policy changes happened at the end of last year, which you've already said it was the start of the softening of the market down to the 20% deposit needed. It affected the first home buyer. Clearly did. Do you think it's affected the investors market too much from what you've seen?
Yeah, well, in different ways. Bearing in mind that I'm a reasonably big investor myself, so not only am I a mortgage broker, but I'm actually doing a lot of property-related stuff up here in Auckland. I stopped trading property probably back late 2012. So I didn't trade anything last year at all, and haven't traded anything this year. And look, part of the reason for that is I just felt really uncomfortable with where the market was heading. Back in 2012, I could look at a property and I could see genuine value. But last year I really struggled to see that from a trade perspective, not from a hold perspective. And it's different because when you're trading property, you're obviously sort of trying to figure out your buy price, your renovation costs, and then your outtake. And I really struggled with it, mostly because the sort of properties that I work with require significant renovations. They're not the sort of South Auckland buy, give it a lick of paint, put some carpet in and sell it. I'm typically dealing in the sort of middle to upper end of the market. And the problem with that market is very sensitive, and you don't get your house quite right, and the end value can be quite different to what you expect. And as markets soften, that's the part of the market you typically get caught out in, because people are a lot more selective about what they want. Whereas at the entry level end of the market, people are a lot more pragmatic, and there's a lot more buyers. So I'm pretty greedy when it comes to property trading. I'm looking for pretty good margin in it. Typical margin for us, before tax and GST would be sort of 150 to 200,000.
Yep.
So good margin. Long projects, they generally take 6 to 9 months, but they're also risky in that if the market turns on you, if you don't get it quite right, if you have cost blowouts, if you don't finish the house properly, you can end up on the wrong side of the ledger. So, so I stepped away from that back in end of 2012. Didn't go through last year. It was just a bit crazy. And because of the time it takes us to renovate these things, I just didn't want to get caught in the market turning. What I have seen is a number of traders who have been doing similar stuff to me, starting to get caught out.
Right.
And that's just a reflection of how much the market has softened up here in Auckland. And so I think, for people out there that are trading, and, we still get newbie traders coming in. We get people coming in and saying, right, I want to trade property. And it's like, okay, if you were doing that 2 years ago, great, but you're kind of coming in after the party's finished.
Yeah, it's really interesting to hear you say that, because, we've been doing several trades on a smaller scale than that you were talking about, but shorter time scale as well. And 2011 and 12 were very good years. Last year's impossible to. Again, quite fussy with what we do, and I've got more particular and fussy with what we do. But it's it certainly changed last year, and the market has made it very hard to do the trading. At the moment, so you want to be careful with when you do it, and make sure you're not paying too much when you start. That's for sure.
Yeah, it's a difficult market to trade in, I think, because it's so volatile. The good thing though is that I actually think that with the market softening, that's a good thing, and it does create more opportunity. So, I mean, the buying 15% below market value, you generally only can do that when there's market softness.
Okay.
So this current market, the next 6 months, I think actually is going to have some really good buying opportunities. For people that are prepared to put in the hard work, or have good contacts.
Yep, totally agree, and I think it's the softening now is a great thing for the investors, with getting those opportunities to get 15%, because getting 15% below market value last year was a pretty hard task in Auckland, that's for sure.
Oh, impossible, mate. I mean, the only way you were doing it is if you were planning on your property going up in value.
yeah, that's right. Okay, an interesting question here for you. We all hear about the Chinese coming here and paying over-the-top prices for our property, and especially in the last 12 months, we've heard a lot of that at auctions. You have a bit of that market that goes through your office, as you've already alluded to. Is that correct, or what's your take on those comments that people were saying?
Yeah, so I might take a little bit of a step back on that one, come back to it directly. But I mean, it's interesting because, if I look at 2013, 2013 was an incredibly strong year for obviously property price appreciation, particularly in the Auckland and Christchurch markets. Christchurch we understand because of the earthquake. Auckland, it was a bit more interesting. This notion of a property shortage got huge coverage last year. It's a conversation that had been going for a while, but last year, kind of all the ducks lined up, and everyone was like, you can't go wrong with property. There's a shortage of houses in Auckland. Property prices always go up. So, yeah, that's a kind of general thing. And so people were feeling very confident that they could buy and that prices would be higher a month or 2 months later. And that kind of gets a bit of a run on, and you just get this ongoing sort of price appreciation coming through, which is clearly stopped now, but was going through 2013. I don't think there's actually the property shortage that everyone talks about, and that's why it hasn't really translated through to rents. What typically happens in the market is that in your poorer areas you get sort of higher occupancy per household, and you get gentrification around the city fringe, and then that's pretty much what we've seen over the last 2 or 3 years. So what were poorer suburbs suddenly are the hot new suburbs. And that's great for investors, because if you can pick those trends, you can do very, very well out of property. So, you're sort of in an Auckland context, because that's where I operate, sort of your Otahu's, your Avondales, your New Lyns, all of those areas have really surged over the last 2 or 3 years as those suburbs have gentrified. But in the absence of this sort of property shortage, I think the two big drivers, last year in the market, one was the Chinese buyers, and the second was the unitary plan, and probably a combination of the two. What the unitary plan did is it was a great speculative opportunity because suddenly everyone was thinking about subdividable land. And I'd be a poor man if if I gave you $1 for every time I had a conversation with someone about is this land subdividable under the unitary plan.
Yeah, I can imagine.
Um, it seemed to be what everyone was talking about, including the real estate agents. I mean, whenever they were selling their house, it'd be like, yeah, but under the unitary plan, you'll be able to get a second dwelling on this site. The unitary plan really became quite a sort of a magnet for conversations around making money out of property, and so it almost became a bit speculative. And it'd be fair to say that the Chinese were very big buyers last year, and certainly buying up land, which is pretty much what is probably their favorite thing.
Yep.
I'll use one example. I purchased a piece of development land a couple of years ago in New Lynn. And it's a good bit of land. It's about 7,000 square meters of land. And I was getting it valued the other day. And so did a comparative analysis of other pieces of development land in the area within a 5K radius. And there were 12 other pieces of land that had been sold in that area in the last 18 months.
Mm-hmm.
And of those 12 pieces of land, over 12 pieces of land over 2,000 square meters and under 10,000, of those 12 pieces of land, 9 had Chinese buyers.
Right. Okay.
Right, so 75% of the developments and land sold around my piece of development land in New Lynn was to Chinese buyers, and now that's not foreign buyers flying and buying up land and disappearing. That's New Zealand resident Chinese buyers, and it's just a reflection of what they like. They're property investors, and they're passionate about property, and they're particularly passionate about land. So whereas probably the traditional Kiwi, hard-ass property investors much more focused on yield. With most of our Chinese investors, yield doesn't really come into it at all. It's all about capital growth and land.
Through the long term, what they can do with it in the future.
Yeah, totally. I mean, if ever there were land bankers, that would certainly be true of the of the Asian market. They take a very long term view of property. They're not in it for the short term.
And there's a lot of reasons why, I think, too, with the culture in some families over there also, from what I've learned in the last couple of years, and why that happens.
Yeah, there's a lot of reasons for it, but it's not. I guess the key point, and where the conversation ends getting really mixed up, is that often everyone goes, foreigners coming in and buying up all the land, and I think that's a real red herring. We don't see a lot of that. There's not a lot of sort of foreign investors coming in here and buying up land or houses and then disappearing. Again, it does happen, but what we've got to realise is that, I think, I forget what the stats are, but, it's something like 40 odd percent, or a huge chunk of Auckland or Aucklanders weren't born in New Zealand.
It's only going to get bigger and bigger. Yeah.
Yeah, I mean, it's a very part of our society now, and so it's actually New Zealanders or New Zealand residents that are buying all this property.
Yeah.
And it just happens that culturally within our community, there are groups that are probably even more passionate and excited about property than maybe the traditional Kiwi battler.
Yeah, no, that's right. Oh, great work. Okay, well, let's get a bit of knowledge from you. You're out there doing a few things. You're in the news a lot. You're answering different questions and making statements. How do you keep current in the market? I've got here through your own personal investing or through your clients. Obviously, you've already spoken quite a bit about your own personal investing, so I presume that will be your the main way of keeping current in the market, so you know what's happening.
Yeah, look, I spend far too much time on the internet. I think my wife would say I'm addicted to news, which is quite bad actually. I read a fair bit, and not the New Zealand papers because the New Zealand newspapers are pretty poor quality.
Yeah.
You don't really get a lot of what's going on. So I tend to read. I actually read a lot of blogs. And overseas commentators and that sort of stuff. Probably one of the sites that I do like in a New Zealand context is interest.co.nz. The top 10 that they seem to run 2 or 3 days a week, is a pretty much a religious read for me.
Yep.
And often I actually follow the links through from the articles through to the original source material.
Right.
And read that. But it probably comes with the job a little bit. Obviously, being in the finance industry, we need to stay on top of what's going on out there. But as an investor, I probably get a lot of that from clients as well as what I'm doing. There's something magic about talking to other business people and other investors literally all day, every day.
Yep.
You get a real feel for how other people are thinking, what they're doing. Some of I guess my success has come from me being able to see what other people have been doing really well. Which is great.
No, absolutely, it makes sense. And yeah, I mean, like me, I'm passionate about property, and I enjoy talking to new and different people every day. And it's great just hearing what people are doing and come from and helping others. It's great being in the middle.
Yeah, and I think one of the key things though, they always say it, but surround yourself with people that are as equally as passionate as yourself. I mean, it's good fun and they're enjoyable people to be around.
Absolutely. And carrying on from that, for the new investor out there, and there will be a few listening, and maybe not the so new, we all like learning from others. What are some good strategies that you can recommend in their investing? So probably more I suppose the new to mid investor. You've already spoken about the developments of different natures.
Oh, I don't know. I think the it's all about sort of just trying to find ways of adding value. Look, I mean, I'd probably like to hold a lot more property long term. I'm not your classic long term investor at the moment, so most of my property is development related. So I'm doing a 35 house subdivision in Avondale. Doing another 18 townhouse development in New Lynn. Interestingly, the Avondale one we're selling, so we've pre-sold it off plan. But the New Lynn one, we're keeping the entire development.
Okay.
And that's, for me, I got a bit sick and tired of having individual properties sort of scattered around town.
Yep.
And what I decided is that the best way of creating equity, but also managing your portfolio, was to have a bit more concentration. So what I'm tending to do going forward is to build blocks of units and keep them.
Yep.
Because you can get some really good capital growth through that process to recycle your equity, but you also get a good yield. And it's very difficult, particularly in a market like Auckland, getting capital growth and yield together unless you go down to South Auckland. So the only way you can really do it in the city is when you create it yourself.
Absolutely.
And so doing a bit more of that. I think, I mean, the easiest formula that I've ever seen really for doing well out of property is converting properties into multiple incomes. Tried true, easy formula, works every time. And that's really the crux of it. Whether that's subdividing a property and getting two houses on it, whether it's putting in a minor dwelling or converting something into a home and income, or just adding bedrooms. That to me seems to be the really tried and true formula for building up a good portfolio.
Yeah, that's great. Yeah, it is, and that's where people sort of are starting out need to try to strive to be in, whether it's 5 years, 10 years, or whenever it is, to be in a situation they can do that. And as you said, I mean, people they start out by having properties in a few different locations, I guess, to get going and
Yeah.
get the capital gains, and then if later on down the track, if you can do now what you're doing there is having them all compact, that's a great situation to be in. That's awesome.
Well, I think yeah, you got to start somewhere, and I certainly didn't start there. You can't suddenly just go out and build a block of units. It's actually quite hard, and you need a fair bit of money to do it.
Even though some people think they can, but yep.
Yeah, so it's pretty tough. Trust me, it's hard to. But yeah, no, I mean, look, I think that's what happens when you get bigger. So often, people start off in residential, they build up a portfolio of maybe 9 or 10 properties, and then they start to go into commercial property because it's kind of easier to manage. And I think it's just the sheer. I mean, look, everyone's different. There's people out there that have 50, 60. I think I'm dealing with someone at the moment that's got over 100 residential properties. And it's really hard to do their statement of position. But, you know, I mean, so everyone's different. But a lot of people tend to get up to a certain amount of residential and then sort of start to look for bigger projects. And I guess that's what I did. It just sort of makes it a little bit more manageable.
Great work, awesome. Just one thing I'd better ask, because people will go, "Hey, Mark, why didn't you ask this guy? He's out there, he's doing the business." So where do you see the Auckland, I'll say Auckland because not the rest of the country, it's where you're sort of based in the market you're in. Where do you see it happening in the sort of next 12 months to sort of 4 years? And I won't sort of get you to talk about the Auckland market. I deal with the rest of the country a lot.
Yeah.
You deal with the obviously Auckland market more than I do.
Yeah. Okay. So I think this year's going to be flat as a pancake. Um, you've got an election coming up in September, which is going to be quite distracting, and you know that's traditionally, I guess, the start of spring. So I think this year's election will be a bit of a distraction because you've got all these potential coalitions and all sorts of weird and wonderful policies that you know could potentially impact on the property market. You've also got you know the initial stages of a rising rate environment with the Reserve Bank coming out and doing these OCR increases, and you've got these restrictions coming through like the LVR restrictions that are currently in place, and you know some of the tweaking that we were talking about earlier with investors and stuff coming through in June, July. So I think all of these things have slowed the market down quite a bit. And my sense is that even with a number of investors, it's causing them to pause a little bit and just sort of see sort of how that flows through. But you know, for the ones that are sort of counter-cyclical and you know basically get into the market when no one else is, that's actually a good time.
Yeah, I'm seeing a lot of. I'll just jump in from it. I'm seeing a lot of investors right now, more so than a year ago, who are out there actually getting in the market, trying to get in the market at the moment.
Yeah, no, yeah, mixed bag. There's definitely some of my sort of probably older investors that have been around for a while and kind of know what good value looks like are definitely getting warmed up and back in the market.
Ready.
And probably starting to get a little bit more optimistic that they can find some good deals out there. But you know, it's certainly not as strong as it has been. It's funny because investors sort of fall into two camps. You get the ones that get their confidence from everyone else around them, and you get the ones that have self-confidence. People with self-confidence will be going into this market. People who rely on getting lots of good headlines and aren't that disciplined about what they look at are the ones that are probably back on the fence. And that's you know, so it's the serious investors, it's ones that actually treat it, you know, properly that are still in the market, and that's a good thing. And you would expect that in this kind of market.
Well, but just before we wrap up, is there anything finally you'd like to sort of mention to any of the listeners at the moment, or we've pretty well wrapped it up?
I think we've covered a fair bit
We
today.
certainly have.
So,
Yeah,
honestly, I think I'm talked out, which is unusual.
great work. I always love a challenge. Hey, John, from the Property Ventures team, all the listeners listening today, I'd really like to thank you for your time. It's been a great insight to many, many topics that's so important to the investor. So thanks for your time today.
Hey, no worries, mate. Good talking to you.
We would like to thank John for his time. He has given some great clarity about the OCR in the future 18 months, along with the best way to work with your broker. If you have any suggestions on who you would like to hear on one of our podcasts, you can contact us at propertyventures.co.nz. Thanks for listening and have a fantastic day.